FY25 earnings conference call, hosted by Dolat Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Aman Mehta from Dolat Capital. Thank you, and over to you, sir.
Thank you, Manav. On behalf of Dolat Capital, I welcome all participants on the call and thank the management of Satin Creditcare Network Limited for the opportunity to host this call. For today's call, I have with me the members of the management and leadership team. This includes Dr. H.P. Singh, Chairman and MD, Mr. Jugal Kataria, Group Controller, and Ms. Aditi Singh, Chief Strategy Officer. And with this, I now hand over the conference to Dr. H.P. Singh, Chairman and MD, to preside over the call. Thank you, and over to you, sir.
Thank you, Aman. Good evening, everyone. Thank you for joining to discuss our performance for the third quarter and the 9 months of the financial year 2025. We are already a month into 2025, and I hope it has been a fruitful and healthy start for all of you. I wish you all continued success and well-being. I trust you would have had a chance to review our quarterly results and investor presentation. If not, they are readily available on our website and stock exchanges. In my years of experience in the microfinance sector, I have witnessed its evolution through periods of uncertainty and challenges. There have been moments when questions arose about its resilience and the perceived vulnerabilities of its business model. But time and again, the sector has not only endured but has emerged stronger, demonstrating the depth of its foundation and the strength of its purpose. Even now, as it evolves through a volatile phase, it is reinforcing its framework with a renewed commitment to best practices, charting its path forward. But in navigating these challenges, we cannot lose sight of what truly defines the sector. It is its cause in the inclusion space. While some borrowers may struggle with repayments, it is important that we may not let these cases overshadow the needs of those who genuinely rely on access to credit. For instance, if we look at the PAR numbers of Satin, PAR 1 stands at 6.4%, meaning the vast majority of borrowers continue to repay responsibly and on time. It is our responsibility to ensure that these committed borrowers are not deprived of financial access due to the challenges faced by a few. In fact, our PAR 1 has improved from the last quarter, which is an encouraging sign. This reaffirms the continued demand for credit, improved repayment behavior, and the importance of ensuring access for those who need it most. Every day we see stories of resilience and ambition, individuals who take small loans and turn them into life-changing opportunities. This is the true strength of microfinance, and we at Satin are proud to be a part of this larger mission, standing alongside those who are shaping their own futures. At Satin, the journey of 34 years of experience has given us not only the wisdom to navigate challenges, but also the resilience to emerge stronger each time. Our legacy and sustainability are built on a foundation of strong governance, best-in-class risk management, innovative approaches, disciplined underwriting, and robust business models. These principles have been instrumental in ensuring that no crisis defines us. Rather, it is how we overcome them that shapes who we are. Whether it was the 2010 Andhra Pradesh crisis, despite having only started the JLG model in 2008, we raised capital of 24.3 crore and continued to grow through those turbulent times. Or during demonetization, when the entire sector faced disruption in portfolio quality, we were more impacted due to our significant portfolio in UP. Our own PAR 1 bucket peaked at 45%, and yet we remained focused on recovery and steadily brought it under control. Even during COVID, when stress levels were high across the industry, Satin managed to keep its credit costs among the best in the industry. As well as in today's challenging environment, we continue to hold one of the strongest positions in terms of asset quality, demonstrating our disciplined risk management and operational excellence. That has been the same pattern all along. We have never waited to surpass and emerge more resilient each time. profit of rupees 31 crore, coming across amongst the best in the industry and also reinforcing our financial strength, operational efficiency and disciplined execution. Our consistent performance and commitment to excellence have also been recognized on prestigious platforms. We are honored to have received renowned accolades, including being named the Microfinance Organization of the Year at the Global Inclusive Finance Summit 2024 and being recognized among the top 15 companies with great managers at the Great Managers Award 2024 for the fourth time. In the reporting quarter, I would like to touch upon the SRO's guardrails, which continue to reinforce the industry's focus on transparency, asset quality, and stakeholder protection. Since the company has been following the good practices even before the implementation of Guardrails 1.0, currently there has not been much impact on our portfolio. With Guardrails 2 coming into effect completely from 1st April 2025, we are fully prepared for a seamless implementation as reflected in our December 2024 performance. As of December 2024, only 5.4% of our existing clients had more than 3 lenders at the time of disbursement. Further, for loans disbursed from April 23 to December 24, the percentage of clients with loan exposure exceeding rupees 2 lakhs remained minimal at just 0.03%. These numbers reaffirm our disciplined approach and readiness for the regulatory shift. More details on this are available in slide number 5. We would now like to draw your attention to slide 6, 7 and 8 on the asset quality update. Our portfolio has experienced reversal in delinquency trend, with improvement becoming materially visible across various markets since November, strengthening further in December and January. Net fresh PAR flow has seen a significant decline, reducing from 1.61% in October 2024 to 0.45% in January 2025. Additionally, PAR 1 stood at 6.4% in Q3 FY25, improving from 6.8% in Q2 FY25. When compared to the industry, Satin continues to outperform. As per CRIF High Marks data, the PAR 1 for NBFC MFI stood at 13.9%, whereas R remains significantly lower at 6.4%. Furthermore, in our top 5 states, Uttar Pradesh, Bihar, Assam, West Bengal and Madhya Pradesh, PAR 1 stands at 5.6% compared to the NBFC MFI industry average of 15.3%. This outperformance is driven by a strong client relationship and disciplined portfolio management, particularly in key states. The reversal in our delinquency trends aligns with our expectations, reinforcing our confidence that credit costs for the year will remain within the guided limits. With improved borrower discipline and a focused recovery strategy, our overdue portfolio has been stabilizing across key geographies. Early indicators suggest a steady normalization of repayment behavior, further strengthening our outlook. The collection efficiency for the X bucket stood at 99.8% during Q3 FY25, again demonstrating continued portfolio stability. Additionally, we registered strong recoveries against write-offs amounting to rupees 27 crore for the first 9 months of FY25. In our top 4 states, which collectively account for approximately 61% of our own book portfolio, the PAR 90 stands at 3.0%, notably below the national average of 3.9% as on December 24. While there has been a slight degradation in asset quality across these states, this has been largely influenced by on-ground external factors such as localized weather-related disruption and borrower stress in certain pockets. However, fresh PAR inflows have significantly reduced, indicating early signs of stabilization. Specifically, Uttar Pradesh and Bihar, contributing around 41% of our on-book portfolio, exhibit strong performance with PAR 90 figures below our national average. This is particularly noteworthy given the recent industry reports indicating rising delinquencies in Bihar and Uttar Pradesh. Despite these challenges, our portfolio in these regions have demonstrated resilience, reflecting the effectiveness of our strategies. Encouragingly, approximately 69% of our portfolio across states has a GNPA of less than 3.9%. Reflecting the strength of our asset quality and disciplined credit practices. Additionally, West Bengal is showing signs of improvement, with PAR 1 decreasing from 8.6% in September 2024 to 7.7% in December 2024. This positive trend indicates effective portfolio management and recovery efforts in the region. In line with our prudent risk management approach, as we continue to maintain a healthy provision buffer to safeguard against any potential uncertainties, as of December 2024, we have an on-book provision amounting to 322 crore, which represents 3.9% of our on-book portfolio, well above the regulatory requirement of rupees 136 crore as per RBI norms. We have created a management overlay of 16 crore, reinforcing our proactive approach in strengthening our financial position and creating an additional cushion for the coming quarters. In the last quarter, we highlighted a transitory increase in delinquency influenced by various external factors across a few geographies, namely Punjab, Rajasthan, Maharashtra, Odisha, and Jharkhand. I'm happy to share that our performance in 3 of these states, Punjab, Rajasthan, and Maharashtra, has shown signs of improvement. Together, they account for approximately 10% of our on-book portfolio, and PAR 1 on these states has declined as a result of focused intervention on quarter-on-quarter basis. As on December 24, in Punjab, PAR 1 reduced by 240 basis points quarter-on-quarter to 4.6%, while the industry average remains significantly higher at 32%. In Rajasthan, it declined by 303 basis points quarter-on-quarter to 7.8%, whereas the industry stands at 21.2%. In Maharashtra, it dropped by 310 basis points quarter-on-quarter, now standing at 8.5%. As per industry, it is 8.7%. This improvement is a result of our proactive intervention, including stricter underwriting standards for new client acquisition, a calibrated slowdown in disbursement in impacted regions, optimization of CSO spans, deployment of additional collection officers, and a strengthened client engagement framework. With delinquency trends showing clear signs of improvement, our commitment to grow remains strong, reflected in our AUM. The consolidated AUM grew by 10% YOY to rupees 12,128 crore, while the standalone gross loan portfolio increased by 10% to 10,778 crore. For 9 months FY25, consolidated disbursement stood at 7,568 crore, registering a 2% growth, while standalone disbursement reached 6,955 crore, up 1%. This consistent disbursement trend underscores our disciplined lending approach. Furthermore, the quarter-on-quarter stability in disbursements have contributed to a sequential AUM growth of 3%, reaffirming our commitment to sustainable expansion. I would like to take a moment to discuss the current status in the state of Karnataka. Given our relatively low exposure in the region, we have decided to pause disbursement there for the time being. We are currently in wait-and-watch mode, carefully assessing the evolving situation. Based on our observation and market conditions, we will take appropriate actions as needed. Our consolidated branch infrastructure stands at 1,535 branches spread across 483 districts and 29 states and UTs. On a standalone basis, we operate in 1,421 branches. Coming to our financials now, during 9 months FY25, the company's overall revenue grew by 24% year-on-year to 1,979 crore on a consolidated level, and on standalone basis, it reached 1,815 crore, marking a 25% increase. The pre-provisioning operating profit stood at 625 crore, registering a growth of 26% year-on-year on a consolidated basis. On standalone basis, the PPOP stood at 610 crore, up by 29%. This growth reflects our focused strategy and operational efficiency in spite of the difficult dynamics. For 9 months FY25, the consolidated PAT stood at 164 crore with a ROA of 2% and ROE of 8.8%, reflecting our sustained operating profitability. Beginning in Q1 FY25, we proactively initiated early recognition of stress across the portfolio, enabling us to address challenges head-on and implemented targeted interventions. As mentioned in our previous results, these initiatives included focused recovery strategies, new customer acquisition guidelines, strengthened underwriting practices, and enhanced processes. These efforts have started yielding positive results as we've seen visible improvements in key performance indicators, reinforcing our commitment to maintaining a healthy and resilient portfolio. There have been ongoing discussions around employee attrition in our sector. To address this, we have proactively implemented multiple employee welfare initiatives aimed at enhancing engagement, retention, and overall workplace satisfaction. We remain committed to creating a supportive and rewarding environment for our employees, ensuring that we attract and retain top talent. Additionally, we strongly believe in recognizing and nurturing internal talent by providing them with the opportunity and the positions they deserve. On the borrowing front, in 9 months FY25, the company raised 6,216 crore at the group level from various lenders, maintaining healthy liquidity. Further, the company's financial position on standalone basis remains strong with CRAR of 27.4%. As of 31st December 2024, the company has adequate liquidity of approximately 1,581 crore coupled with undrawn sanction of 1,435 crore as on date. As we move forward, our guidance remains unchanged from the previous quarter, and I'm pleased to share that as of 9-month FY25, we have delivered consistent results in line with the guidance. We have achieved an AUM growth of 10% YOY against our guided range of 8% to 10%, which reflects robust performance and effective execution of our growth strategy. Additionally, our credit cost stands at 5% annualized, well within the guided range, underscoring our discipline, risk management, operational efficiency. Now, let me run you through the financial operational highlights of our company. Starting with consolidated highlights, we have a customer base of 33.9 lakh customers, 33.9 lakhs as on 31st December 2024, with presence spanning in 1535 branches across 483 districts in 29 states and UTs of India. Our top 4 states contribute to 56% of AUM as at Q3 FY25, and the states are UP, Bihar, Assam, and West Bengal. Now, coming to standalone highlights, our average ticket size of MFI lending for the 9-month FY25 stood at 53,000. We have a well-diversified customer base of approximately 33.2 lakh clients with 76% rural exposure. Pan-India presence with 1421 branches. PAT of 9 months FY25 stood at 175.5 crore, ROA of 2.2% and ROE of 8.5%. The shareholders' equity stood at 2,830 crore as on 31st December 2024. GNPA as on December 24 stood at 3.9%. The overall provision coverage ratio increased to 99% versus 83% in December 23. Total borrowing stood at 7,829 crore as on December 31st, 2024. Debt to equity ratio as on December 31st, 2024 stood at 2.8x. As on 31st December 2024, 96.9% of our districts have less than 1% of our AUM. An update on subsidiaries. As a one-stop diversified financial services provider for rural India, our subsidiaries work collectively to expand financial access. Leveraging our strong microfinance outreach, we provide affordable housing and retail MSME loans to clients who have completed 2 or more loan cycles with us and require high credit score. Satin Housing Finance Limited has now reached an AUM of 872 crore, which grew by 44% year-on-year, having presence across 19 states with 8,464 customers. SHFL has a 100% retail book, GNPA of 1.7% as on December 24. The company has 31 active lenders, including NHB Refinance, CRAR of 59.61% and gearing of 1.9x. PAT of 9 months stood at 2 crore. Trade rating of A- stable from ICRA and Infomerics. Satin Finserv, the company's MSME lending arm, has reached an AUM of 479 crore. We are running down the business correspondent book and focusing on building retail MSME book going forward. MSME on-book portfolio grew by 50%, CRAR of 42.2% and gearing of 1.8x. 18 active lenders, including banks, impact funds, etc. Credit rating of A- stable from ICRA. As we approach the end of our discussion and before we move into the Q&A, I would like to take a moment to express my appreciation for our strong and dedicated management team. Their expertise, strategic vision, and a strong commitment have played a critical role in navigating challenges, strengthening our foundation, and driving our performance. With a team of seasoned professionals from diverse backgrounds, we have created a leadership framework that is aligned with our mission of driving sustainable growth and financial inclusion. This is a team that has grown with the company, evolving alongside the business and demonstrating resilience in an ever-changing landscape. Their collective experience and ability to execute with discipline and foresight have been instrumental in maintaining our strong market position. In closing, as we forge ahead on our journey of growth and innovation, we are confident in our ability to achieve higher growth while maintaining financial discipline and operational excellence. With a clear strategy, strong fundamentals, and an unwavering commitment to financial inclusion, we remain well positioned to navigate challenges and unlock new opportunities. Thank you all for your valuable time. We look forward to answering all your questions during the Q&A session. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets only while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. I repeat, if you wish to ask a question, you may press star and 1. Ladies and gentlemen, a reminder to all participants, if you wish to ask a question, you may press star and 1. We have our first question from the line of Rishikesh from Robo Capital. Please go ahead.
Yeah, good evening. Thank you for the opportunity. I'm audible?
Yeah, you are.
Yeah, thank you. So my question is that given years of experience that you have in the MFI industry, how is this?
Your voice is not clear. Rishikesh, hi, sorry, your voice is not clear.
Hello. Audible now?
Oh, now it's even getting worse. I think you're in a bad network patch.
Okay, let me try.
Sir, can you use your handset?
Yes. On handset only.
Okay, so...
I think you have a network challenge, Rishikesh.
Am I audible now?
No, sir. Your voice is still breaking.
Fine. Let me get back in the queue.
Sure.
Manu, we can take another question.
Sure, ma'am. We have our next question from the line of Anant Mundra from My Temple Capital. Please go ahead.
Hello. Thank you, sir, for the opportunity. Firstly, sir, congratulations on a great set of results in such challenging times. We've shown excellent performance in our X-bucket collection efficiency, and that's quite commendable. Sir, I just wanted to understand. So my first question was around when do you expect the credit cost to normalize? Because for us, as I see currently, our SMA 0 bucket has considerably reduced quarter on quarter because our X-bucket collection efficiency is good. But the stage 2 assets have kind of floated, and that could be an irritant for us going forward. So when do you expect the lag of that to completely be over?
See, my own guess is, I think, if I give you brass tacks baseline numbers, till October, I think, we were still having par flows coming in, but since November, as indicated in my speech, earlier, we've arrested the flow. I think, it is not there. So my sense is that whatever happened during October, give it 90 days for it to reach its peak, basically. So I think, this quarter will be maybe probably the last of our quarters, to have a little challenge. But beyond that, since November, December, January, I think, these 90 days have been pretty good. I think, it'll probably be much better from my sense is April onwards in any which case, It's just probably the October month, which is probably just a slight irritant which is there in for us. Rest everything is much below our earlier estimated par flows, which were there.
Okay, so there could be some flow over of that September-October bucket into Q1 of next year. So maybe Q2 is something where we can expect absolute normalization in credit costs?
Absolutely, 100%. That's what I said. October, 90 days from there, 31st October, it comes into January. That's the only irritant we've got, But if you look at our numbers from November, December, January, I think, the next 90 days probably are this thing. And we hope, looking at, how we are looking at, containing the power flows and the way we've been able to address the challenges, I think, for us, February, March also bodes very well, So I think, we are probably on the way where we are arrested our par 1, which came down from 6.8% to 6.4%. I think that is probably one of the biggest signs which we are probably demonstrating in our portfolio.
All right. And so do we expect any further challenges arising from Guardrails 2.0, which will be implemented from April? Like, could there be a fresh round of par accretion because of that?
No. So our rejection rates, which are currently at about 60-odd%, will increase by another 8 to 10%. So I think we will have probably more difficulty in navigating our growth, but we will certainly be able to do that because we've already worked on Guardrails 1. Our rejection rate was 60%. I think they will increase to about 70-odd%. Once we implement Guardrail 2. But our technology and our software and everything is ready. The moment it is implemented, we'll be the first one to implement that and move forward. But no accretion on the credit quality because of that. And in fact, it's going to be better and healthier for us.
Oh, so, sir, if I see one data point, so our Satin Plus 3 customers has actually gone up from 4.2 to 4.5% quarter on quarter. So it appears that we are giving out loans to the Satin Plus 3 customers, which will not be able to going forward from April. So do you expect, you feel like there could be some stress because of that, because those customers will no longer be eligible?
बस थोड़ी सी शांति 4.2 से 4.5 हो गया 0.3 में it is like stable, you know.
So we have said that the rejections will increase by 8 to 10%.
So
then
these guys
we will not lend to them.
Yeah, we will not. It will not come, you know.
We were lending to them because it was allowed. So whether it was 4.2 or 4.5, it was well within the allowed.
That's what I said, you know, we will have an increase of about 8 to 10%, you know.
Got it. So I would also assume that because the ex-bucket collection efficiency has been good, can we expect disbursements to increase quarter on quarter from Q4 significantly as compared to Q3? Because Q2 to Q3 has been kind of flattish.
No, we will be very cautious. I'll be very honest with you. I think, you know, for us right now, our whole focus is completely on par quality. Profitability. For us, growth is not something, you know, which we are really looking at. We have enough time on our hands to look at growth. But I think, you know, first we want to set all this right. We've got 2 states, you know, which are still, you know, demonstrating stress. We want to, you know, work on those and have all the states practically, you know, out of the stress. You know, Odisha and Jharkhand, you know, we're working very hard on that, and let's see if we are able to get some more positive results on them. Then overall, I think our asset quality will probably be, will probably be the best, you know.
Got it. So for Q4 we can assume the same sort of disbursement number that was there for Q3.
Yeah, kind of.
Okay. Yeah. And the collection efficiency trend so far in Q4 from Jan till Feb 10 has been in that 99.8% for the ex-bucket?
Yeah, it's been.
That positive trend is continuing. Okay. All right.
Yeah, it is.
And so this management overlay of 16 crores that we have, that's lying in our, is it in the stage 2 bucket or is it in stage 1? Where does it lie?
So this is on 1 to 90. We have created that overlay.
Oh, it's on 1 to 90. Okay. Got it, sir. That's it from my end. If I have any more questions, I'll get back in the queue. Thank you.
Sure. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to take questions from all participants in the conference, please restrict yourself to 2 questions per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Pranav Gupta from Ionios Alpha Investment Managers. Please go ahead.
Hello.
Yes, sir. Please.
Yes, sir. We can hear you.
Am I audible?
Yeah.
Yeah. Hi. Good evening, and congratulations on a good set of numbers. So just a couple of questions. The first being that if I look at Satin Plus 3 or Satin Plus 4 customers, that number has been fairly under check, especially over the last couple of quarters. When we sort of compare this with the industry numbers are significantly higher. I would assume that a large part of the curtailed stress in our book versus peers has been mainly because of this number being lower. Could you talk about some of the measures that have led to this number? Because, a lot of other players, when we speak to them, mentioned that, maybe they were the second or the third lender and lender plus 3 or lender plus 4 is being caused because of a couple of other players who lend later. So how do we protect ourselves against that, and what has led to this good performance on this over-leveraged customer base?
See, Pranav, it's not only just one factor which defines your asset quality. It is a combination of a lot of factors, This is one of the key factors, certainly, yes, but I have nothing in hand to probably, look at it, that what happens after I've disbursed, But for us, it is not only we are looking at the 3-lender base or a 2-lender base, We have credit scores which work full-time for us. We maintain a policy of doing 1 loan per customer. We never have looked at, over-leveraging our customer at any which point. We have worked on NPC, new to credit clients, in about 800 of our branches. That has not been implemented. Now we started with 200 odd branches, went up to 500, has gone up to 800, New to Satin clients also, in about 300 odd branches, we stopped that. So it's not just limited to only one guardrail which is there, which people are talking about. There's more to it, We've taken several initiatives in terms of looking at employee benefits schemes, In fact, if I share a data point with you, for us, our regional managers, technically, out of about 104, about 80 5% of them have a vintage of more than 5 years. So I think, it's a combination of everything which works together. So we've actually looked at complete ecosystem rather than just looking at one aspect of doing credit discipline. So this is how we've worked. This is how Satin works, basically. So this is where it is now. We've never given loan to any delinquent customers, ever. Now, that is also one of the key factors which is there. So I think, the combination of all this actually entails where we can talk, I think, with a lot of stress that, yes, our credit cost is 5%, which is practically one of the best in the industry. So, and it will probably remain at that, So it's not just that, I think there's a lot of other things, which have gone into this.
Right. Fair enough. The second question was on the top two states. You mentioned in your opening commentary, and it's visible with the numbers as well, that we are much better than the industry in terms of the stress that we have seen in those states. How should we look at this going forward, in the sense that do we believe that once the industry starts seeing growth, and maybe when we are more comfortable in terms of increasing disbursements, these couple of states, or maybe some of the ones that are recovering pretty well, can be can drive growth going forward, given that maybe industry is a couple of quarters sort of behind us in terms of either recognition or in terms of the stress pool that they see. How should one think of those couple of states?
So you are essentially saying the states where we are doing well, when things settle, we may push the accelerator for growth. Do I hear you correct, Pranav?
Yeah. So the question is twofold, right? Only one part is what you said, that those two states, if I name them, UP and Bihar, are huge markets where opportunity is still, under penetration is still relatively higher. And the industry out there is, industry numbers suggest that most players are sort of worse off than where we are. So once we're comfortable in terms of the stress pool that we have there, should we think of it in a way where we will start growing faster or before the rest of the industry does, given that they are sort of behind in terms of recognition?
So Pranav, we've got our own guardrails, on various states and everything to probably look at. Again, as I said, it's a combination of a lot of factors. How's the team in a particular state performing? What is the vintage of my supervisors over there? Where all geographies, we think that we can be able to still have an increased depth in terms of expansion in terms of our geography. So I think, for us, as I said, FY26 is again very cautious. We want to completely put in place everything we've got in our armory, in our bucket, to probably look at asset quality. That's our foremost, thought process. But wherever, if we need to accelerate at some point of time, definitely we will do that. And we have all the necessary resources for us also to do that also. But I think, for right now, for us, it is that are we able to maintain the credit cost at the level where we are, or are we able to bring it down from wherever we are? I think for us, our endeavor is to bring down our credit cost from what levels where we are, and that's our main focus right now. Growth will come. Growth is not a problem. Growth is not something which we are more worried about. It will come at any point of time when we want to do it. But right now, I think the focus is asset quality and the team, which is working on the ground.
Right. So just one last question. Industry overall has seen a lot of aggression issues, especially in the field officer category. What has our aggression been like in the last 12-18 months, and could you give that number out?
It's been stable, but if I give you my, we've got one data point which you look at it. My loan officers, which have a vintage of 1.5 years plus, is close to about 40%. So I think that is something which probably gives us that confidence that even on the loan officer on the ground, we still have a 40% vintage of our loan officers still there with us for the last 1.5 years plus.
Sure. Thank you so much, sir.
Thank you.
Thank you. We have our next question from the line of Amit Mendele from Robo Capital. Please go ahead.
Hi, thanks for the opportunity.
My first question is just a follow-up on the last comment on credit cost. I think this year the guidance was around 5%. So can we expect next year, FY26, to be around 3.5, 4-ish, 4% type of credit guidance?
Your guess is as good as mine. We are working towards it only. That's what I said. For me, for all of us, sitting down in this room and in the entire field, this is what our go-to figure is. We want to bring it down below 3%. That's what our challenge is, and that's what we want to do.
Sure, sir. And assuming that looking at how PAR 1 has turned out for this quarter, and if I extrapolate that further for 2-3 quarters, but typically in 6 to 9 months, typically I think if things settle down, then we could start looking at growing the book again. Is that a fair window of time?
That's a fair thing. That's a fair thing. That's what I said first. Right now, I think thinking about growth is not what is foremost in our mind. Our first foremost thing is, as what you rightly said, for us, we want to beat those 3% credit cost numbers, and we want to beat that. And then, for us, growth will never be a challenge. Growth is something, which we can probably be able to do. That's not something, which...
Right, sir. And just one last thing. How do you see the non-microfinance book, growing? I mean, I'm not looking for any numbers, but like say 2-3 years out, what is the big picture thing? Do we want to scale that book aggressively, the non-MFI book, or how do we see, the composition between MFI and non-MFI book?
See, our idea for the non-MFI book, both are secured lending portfolios, and our whole thought process is that, we want to calibrate it and also have an increasing trend across over there. The base is small, so doing a 40-50% year-on-year growth is not a challenge, over there, and we want to do that, But, since the overall ecosystem is somewhat very shaky right now, I think, the stress is, I think, a lot of people are saying is moving from the unsecured to the secured businesses. So also, we want to be very cautious over there, and that's why we are treading a very straight line also across over there. We're not getting too much into the depth of, just looking at pure growth. We're also streamlining our processes and systems in both these companies, to look forward so that, we are not caught napping at any point of time over there also,
Sure, sir. That's it from me. All the best.
Thank you.
Thank you. We have our next question from the line of Yash Dedia from Maximal Capital. Please go ahead.
Yeah, good evening, sir. Sir, firstly, your PAR 1 number, which is 6.4% as on December, how has this number trended in January and February till date?
I gave you that we'll remain within our credit cost guidance, probably do not have actual numbers as such, but it'll remain within this threshold only,
But we have given you that the flow has, like Sir said in the beginning of his speech, that the flow has reduced to 1/4 of what it was, and it is holding on. So that should answer your question.
Okay. And what is your stage 2 and stage 3 provisioning as of now? Stage 3 we know, but stage 1 and stage 2 provisioning?
Stage 1 is about 0.3 or so. Stage 2, our LGD is about 63%, and we multiplied the PD to get that number. So there are different PDs for 31 to 60 and 61 to 90. But LGD is 62.3% or so in both the categories.
So what is the overall, sir, cover on the stage 2? If you can tell me the absolute number and what is the provisioning that we carry as of now?
Just 1 minute, please. Just give me a minute. Stage 1, the overall provisioning is about 33 crore, and stage 2 is about 71 crore.
71 crore. And what is your stage 2 number as of now? 5.7%, is it? 4.9%.
Part 30 is 5.7 and part 60 is 4.
4.9.
Okay. Understood, sir. And one question related to the industry. So you mentioned a comment that in Karnataka you have stopped fresh disbursements. But, given the new sort of draft guidelines, proposed guidelines. So how do you see this impacting the industry and your own presence in Karnataka?
See, we've got a very small portfolio, and as per the draft ordinance, which we have seen, I think, it makes RBI registered entities out of the purview of the ordinance. So I don't think so that there'll be any major effect coming in. But we still want to take a very cautious stand. That's the reason why we, till the time the dust doesn't settle down and the things are not very clear, we stopped our disbursements over there.
Okay. And finally, on your disbursements growth, so now that you have achieved 99.8% ex-bucket collection efficiency, which is as good as normal times, why shouldn't we increase our disbursements to a large extent in Q4 over Q3? What is the rationale behind keeping it at the same level as quarter 3?
Everyone
wants we want to run it the way we've run it, always, So I think, for us, it's always tread with caution. We've always done that. And right now also we feel, I think, early days as yet, but we just want to tread with caution. And as I said earlier, growth can come at any point of time. It's easy to give money. It's very difficult to recover. So let's do the difficult part first, Aasan kaam to baad mein ho bhi jayega.
Understood, sir. Thank you, sir, and all the best.
Thank you.
Thank you. We have our next question from the line of Shreyas Pimples from JM Financials. Please go ahead.
Hi, good evening. Thank you so much for the opportunity. My question was on net interest margins specifically. We are seeing both on standalone as well as consolidated level net interest margins improve majorly because of increasing yields and lower cost of funds. Can you elaborate on what is driving this change?
So one, that our cost of fund is broadly under control. We have got some good sanctions in spite of whatever is happening in the industry. Par 1 numbers are improving, so to that extent, yield loss on portfolio is relatively less quarter by quarter. A combination of all that, we are managing our treasury better by keeping optimum liquidity, etc. A combination of all these factors, is reflecting in the NIM.
Okay, understood. And sir, the operating expenses have majorly because we have strengthened our collection team. When do you see the operating expenses coming under control? Would this be the trend that operating expenses would be around 6.8, 6.9 of the consolidated AUM? How do you see that going ahead in FY26, 27? If you can elaborate on that, please.
I think it'll take maybe another 2 quarters or so. So we feel that some additional expense on the additional manpower is required to keep the portfolio quality under check. So we'll do that for next 1 or 2 quarters and then take a call when to bring it back to the normal levels. I think we'll keep an eye on for next 1 or 2 quarters and then try to bring it down.
Fair enough, sir. And then on the last part, the 2 states that we have seen the largest stress in, Odisha and Jharkhand, can you elaborate a little bit what is causing the problems in these states, and what are the actions that we have taken? How do you see the normalization coming in those states? If you can elaborate on that, please.
Yeah, there's nothing much to elaborate. This is probably the sector headwind which is happening across every state. We've just picked out 2 states, where we have a slight stress which is there. We are working on our management team across over there. We've made some changes across over there. We feel that we'll be able to bounce back as we bounce back in Punjab, Rajasthan, and Maharashtra. I think we know where to work on it and where to look at it. And in fact, we'll work around it. I cannot give you very specific instances of what to do, but
I think we have given some of the measures in the slide. So of course, while they only look like words, once you implement that rather seriously and religiously, they do yield results.
Yeah.
Understood. Thank you so much.
you. We have our next question from the line of Ashish Tonse from Kotak Securities. Please go ahead.
Hi, team. Good evening. First question is, so what was the write-off for the quarter?
169 crores.
Okay, thanks. Secondly, you've given an ex-bucket collection efficiency of 99.8% this quarter. Can you share the number for the previous quarter, and what is it typically during normal times?
So I don't have it handy. We can take it offline, please.
Okay. Lastly, how do you define ex-bucket collection efficiency? What goes into the numerator and what is in the denominator? If you can share that, please.
Tell me, how do you want to define it as? We'll give you the answer,
No. Sorry, I'll answer. Yeah, sorry. Yeah. So we take the current loans and their collection against their demand.
Okay. And do you include the arrear collections, if at all, in the numerator?
It does not have arrears.
No.
It does not have arrears. Otherwise, it will be 100 plus.
Okay, so this number technically cannot be beyond 100. Understood. Okay, perfect. Thanks a lot. Those are all the questions I had.
Thank you. We have our next question from the line of Amit Mendele from Robo Capital. Please go ahead.
Thanks for the opportunity. Sir, my question is more on the sector. We have been following the sector for now many years and seen 3-4 cycles. Typically, what are the lead indicators that you think one can track? When the credit quality apart from PAR, what can an analyst or management typically track to see that the collection efficiency is going down or the stress is building up?
Track us first, then track everybody else and compare that to that. You'll find answers. Sorry, I didn't want to actually, because you've taken the first question and coming at the last question basically. But see, about the sector, I think you analysts probably know it much better than me to look at what do you have to really look at. It's all same across collection efficiencies, GNPAs, write-offs, credit cost. I think you covered it all. The analysts.
If there's anomaly in disbursement.
Anything, I think you have all the points which are there. And that's why I said maybe in my speech, and I think you have to do your basics right. I think basics. The moment you take you do your basics right, I think lending business is all about the process and systems being followed to the hilt. I think that is probably the one-line answer which I can give. But yes, I think you can track it across collection efficiencies, your credit costs, and your PAR DPD buckets and everything. You have everything. The data is there. For you to track it. Where it's going wrong, where it's not going wrong, where it's probably working right. I think that's where it is.
Well, I think I was asking from the in the back. Typically in Q1, right around June and July, I think most of the companies typically said that this is one-off due to elections and so on, and it didn't turn out to be so. So I was just asking in that context. I mean, but I got the answer here.
So these factors do count, and heat wave was pretty bad. Same was the floods, which were there. Practically, you won't believe it, but flood this time was like practically in every state, every state. Like, you talk of Rajasthan also, there were floods also in Rajasthan. So you have to actually, and it's a door-to-door collection business. It's a physical business which where you take collection. It's not easier where, you can do a check collection or where it actually, you need to hold center meetings, you need to be there, the borrower has to come in. So I think, it really weighs on everybody's logistics mind to probably look at it. So I think, that is also one of the key factors which have probably been a part of, where we all have suffered, because of that, So, and it's been a continuous journey of climate change, which is happening across, I think, you know it or not, but about 10 days during December was very severe cold wave, all across northern India. Basically, it does affect your collection efficiency to a certain extent.
Right, got it. Thanks.
Yeah.
Thank you.
We have one more question.
We have another question from the line of Mona Khetan from Dolat Capital. Please go ahead.
Yeah, hi sir. Good evening.
Good evening.
A few questions from my side.
Firstly, what you said that on growth, you'll be pretty cautious. So just trying to understand that once things normalize, what sort of run rate on growth could we expect from Satin?
See, 10 to 15% is what we look at it, that, from now onwards, whenever we are looking at growth, I think it would be in the range of 10 to 15%, because, again, since we've seen 6-7 years of, crisis brewing, maybe because of external factors, internal factors, whatever, I think the model throws up, my sense is that 10 to 15% is what we're looking at for the SENL. But for the subsidiaries, definitely they are on a different trajectory of a lower base. I think they will probably grow at a faster pace. Rather than but microfinance definitely has 10 to 15% is what we're looking at.
Mm-hmm. Okay. And just trying to understand at the branch level, what sort of center meeting attendance are we seeing currently, and is there any change that we are anticipating in that, or what will be the a more normalized number on the center meeting attendance as we go ahead in your case?
See, last 1 year it has been in the range of 60 to 70%. My sense is it is bound to be in that range only. There is not going to be anything which probably will talk about it that it goes upward from there, but it won't deteriorate also, I think, because the basic fundamental JLG mechanism works on center meeting. So, but it's 60 to 70% is what you can take a fair estimate. So certain states will have higher, like Assam for us has about 90%, 95% attendance rates. But as compared to maybe maybe in Odisha, there we have about close to about 50 odd percent or 55%. Varies according to state to state. Basically that is where the difference lies. But my sense is overall average about 60-70% is going to be what the attendance rates are going to be.
And was this number in the similar range maybe 5-7 years back as well, or was it fairly different? And
5-7 years. 5-7 years we used to be 85 to 90%.
Okay. But this is the more normalized range given the changes we've seen in terms of digitization and everything.
I think we all will have to live with this 60 to 70%. The range will be there between 55 to 70%. Is that the range we will all have to live in?
Mm-hmm. Got it. And just finally, if I have to understand of your FY25 opening book, how much has slipped to the 90 plus bucket in the last 9 months? What would that sort of number be on the gross side?
Slippage for 9 months.
FY25 9 months.
380 around
that number.
Yeah, 389.
Okay, got it. Thanks so much. That's all from my side.
Thank you.
Thank you. Ladies and gentlemen, that would be the last question for today, and I now hand the conference over to Ms. Aditi Singh for closing comments. Over to you, ma'am.
Thank you everyone for taking out time coming on our call, and also on a lighter note encouraging us to grow faster. We hear you all, but we will maintain that our focus is very much there on the asset quality and looking at our strengthened processes. We have tried to communicate that the worst is definitely behind, and we are very much in control in the asset quality and the fresh power flows as established in the presentation and the data set shared by our CMD also in the beginning of the call. We have tried to take all your questions and try to answer them to a satisfaction. However, should you still want to discuss something, you can reach out to me. My name is Aditi Singh, or to my teammate, Ms. Shweta Bansal, who from the Investor Relations team, and we'll be more than happy to discuss with you anything you want to clarify. Thank you so much and have a great evening, everyone.
Thank you, ma'am. On behalf of Satin Creditcare Network Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.